Bloomberg Audio Studios.
Podcasts, radio, news.
This is Bloomberg Businessweek. Insight from the reporters and editors who bring you America's most trusted business magazine, plus global business, finance, and tech news. The Bloomberg Businessweek podcast with Massar and Tim Stenovec from Bloomberg Radio.
And a very good afternoon, everybody, live on radio, YouTube, and Bloomberg Originals. Well, the third FOMC decision, it is on the books. Fed Chair Jay Powell, as we just heard from Charlie, saying it's unlikely that the next policy rate move will be a hike. And that is something to perhaps hang your hat on, Tim.
Yeah, I think investors certainly did
when
Jay Powell said that. We've seen stocks come back around, though, as Charlie mentioned, higher by about 0.2% right now on the S&P 500.
At least on the S&P and the NASDAQ 100, we were down.
We're going into it for sure. The Fed signaling fresh concerns about inflation, though, reaffirming it needs more evidence that price gains are cooling before cutting interest rates from a 2-decade high. Were you surprised by anything?
You and I were laughing. We're like, the Fed and Jay Powell, they're data dependent.
Yeah, high for longer.
High for longer,
as you
exactly.
Said. I made the joke, higher for longer. You said, no, high for longer.
No, exactly. So it's interesting. And in terms of the rate curve, we've talked about this. You heard Charlie walking through the numbers. I think what's most significant is at the shorter end of the yield curve, that 2-year note, which was above 5% right before the FOMC decision, we're now seeing at 4.94. So we definitely a little bit lower here. So it's interesting. I think we got a lot of what we've heard, but Jay Powell, continuing to talk about needing more evidence, sticking to that 2% inflation target, objective, if you will, but a lack of further progress there. So he wants to see more before they're ready to do something different.
I also thought,
or cut rates.
For the first time, I heard him talk politics, or not talk politics, I guess, and say, look, I've been through, and he counted 4 different presidential elections. We are not a group of people who takes politics into account. That's not our job.
Right.
That's not.
It's not a factor that they want to
go back
include.
And look at the minutes.
Right.
I thought that was an interesting moment.
Yeah, exactly. He did say further progress, though, in bringing down inflation, not assured. Inflation, again, showing a lack of further progress. And the path, though, forward is not certain. So, yeah, again, data dependent. All right, first up, let's talk markets, as we should on this Fed Wednesday. We've got a great guest to do it. We've got back with us Doug Ciocca, CEO and partner at Kavar Capital Partners. They've got roughly $1.25 billion in assets under management. He's with us once again from Leawood, Kansas. Doug, good to have you here. It feels like, net after a decision and not quite an hour press conference with Jay Powell, it does still feel like there's data dependent, although there were some nuances there, maybe some tweaks here in terms of his message. But how did you see it?
I think so. I think you and Tim were correct, Carol. Like, it was more data dependent. Market's kind of done a round trip of where it was before the meeting, where it stands right now, particularly relates to stocks. Bond market is a little bit better bid. He was certainly prepared. I think Tim's right for the questions related to politics. I think the timing, in so much as the release over the weekend or last week that his secret committee, Donald Trump, that is, about having more of a presidential influence on the Fed were he to be elected. I think that the Fed was smart to be out in front of reinforcing the apolitical nature of their organization and the decision-making process, and certainly the part about stagflation. I thought that was maybe the best answer for this whole press conference. He doesn't see stag and he doesn't see inflation.
We want to do a rap song. Tim and
I went up to Carol after that, and I was like, Powell's like a little different version of Powell this time.
Did you say spicy? What did you say?
He said he was a little spicy today. I don't know. He felt a little different. Felt like he went off script a little bit.
I agree. I think he felt the consequence of the meeting merited such. I do believe, like, he certainly, and certainly people that have served with him for many years, would reinforce the fact that he doesn't feel any outside influence on his decision-making. Pointing at the record, to your point, Tim, I think reinforces that. But I also think it's his personality that needs to shine through. And I think being in touch with a bifurcated economy is really critical. When he came into office, all of us in the investment business were so excited because he wasn't an academic. Right here, he was someone who had invested, started, and sold businesses. So that touch point with mainstream America and Wall Street were kind of a rare combination. And if he can come through and find the personality in that profile, I think it even magnifies even more his influence.
So what are your expectations, Doug, in terms of what the Fed may or may not do, or should do maybe this year? A little bit of both.
I think the Fed did a really good job today, Carol, the Fed being Jay Powell, of course, is displaying a better understanding of the complexion of the economy, right? In so many ways, our economy is bifurcated. You have the goods economy and the services economy. There are wealth and income lines of demarcation. There are large employers, small employers. And the Fed is handicapped, right, in my opinion, because of the limited number of tools in our policy toolbox. So if they cut rates, that's not going to impact large companies that have termed out their debt. It's not going to impact healthcare companies, insurance companies, or educational entities, but it will meaningfully help small businesses, particularly small banks, small real estate subcomponents. And these are starving for an increase in volume that's going to be courtesy of elevated liquidity because they've been impeded by tighter financial conditions, courtesy of higher interest rates. So the Fed understands, and I thought articulated well today, there are segments of the goods economy, consumer goods economy, broadly negatively impacted by higher interest rates. Credit card debt, subprime auto debt was mentioned in one of the questions. The bulk of the purchasing power in this country, however, is not in that subsector of the economy. They're not going to have their spending patterns impacted by 50 to 100 basis points lower than where interest rates sit right now. So I think the Fed is doing a good job of not letting the perfect be the enemy of the good, because the perfect is not coming, and waiting too long could be problematic. So I think that they are still predisposed to cutting is smart, and understanding the two-speed economy is really, really healthy.
You remind me, Doug, of a question. I think it was Nancy Marshall-Gensler at Marketplace asked about the effect of higher rates on the regular consumer, those who say that mortgages are out of reach for them right now because rates are higher. And Powell was so quick to say, that what hurts these folks more is inflation. And that is what we are trying to do. We're trying to get inflation under control, because if you're living paycheck to paycheck and inflation, and you're experiencing inflation, that's an immediate price increase for your basic goods that you just can't afford.
That's right. No, I don't disagree with that, Tim. It's almost like there's a meeting point in the middle, because access to capital becomes more challenging in the presence of higher rates, put in position to suppress inflation. So there's a middle ground, right? And I think he made a really good point. It's another really good answer that kind of dovetails into both these sub points, is that the Fed has a dual mandate. And when the dual mandate, if one of the mandates is starting to be more under control, being inflation PC now below 3%, we can focus more on job market the fullness and stability. And that will help the consumer that it is in a subprime lending that has unaffordable mortgages. So I think that's one way he was trying to convey that they're in touch with the fact that they do have one blunt instrument, but they have a dual mandate. And the way they're going to lean on the propulsion of one sector, each of that mandate at any point in time, is going to address the greatest number of people in need.
Hey, 20 seconds. What's your best investment idea in this market environment?
Yeah, I mean, we're kind of of the mind that you want to control the controllables, because there's so much variability that exists in the market, and obviously volatility has been elevated. But within fixed income, finding these positive real yields with low to moderate maturities, right, whether it be treasuries, mortgage debt, government agency paper, we've seen these at levels today that we've not seen in 15 to 17 years. Then within equities, keep within reasonable valuations. If the S&P is at 21 times, the average stock's at 18 times, look for those at 15, 16 times, high free cash flow, strong balance sheets, plenty of those in healthcare, energy, financial services, and even in some technology sectors as well.
All right, that's a nice little bucket. All right, Doug, thank you so much. Doug Ciocca, Chief Executive Officer, Partner over at Kavar Capital Partners, joining us from Leawood, Kansas.
You're listening to the Bloomberg Businessweek podcast. Catch us live weekday afternoons from 2 to 5 p.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
As we said, big day, Fed decision. We had some data on the economy. U.S. factory activity contracted. We had that. We also had some JOLTS labor, in terms of jobs openings, and we saw that there's more openings out there. So that kind of plays into what we got from Jay Powell in terms of maybe some softness, if you will, in the labor market. But one industry that we like to pay a lot of attention to, Tim, is, especially when it comes to rate environment policy, is the home builders.
Yeah, stocks in the group up slightly year to date. With more on home builders, we welcome back Brad Dillman, Chief Economist at RPM Living. It's the real estate services and management company and owner of multifamily residential properties and developments. Brad here in our Bloomberg Interactive Brokers studio. Welcome back. How are you?
I'm doing excellent. Great to be here with you.
It's good to have you with us. Okay, so you guys are based in Austin. You've got a client list that owns a portfolio of some $3 billion. You acquire, you build. Remind our audience, though, exactly what RPM does and what insight that gives you on the home building industry.
Yeah, so we're a manager, investor, and developer of apartments. The key part of the business is management. We manage over 225,000 units. So that makes us the third largest in the country, according to the National Multifamily Housing
So
Council.
multifamily owners hire you to do management.
That's right, yeah.
Okay.
Which is, exploded during this
That's
down
the
market.
bulk. Is that like 90% of your business?
Yes.
I was trying to get an idea because your website talks a little bit about investing and stuff, but it's really about management.
Yeah, and we have about 20,000 units that are invested in too, but that management part, third largest in the country, that's something. A lot of data there too.
How do you scale management though? Because at the end of the day, management is about solving problems on a very small level that can add up to something big if they're not addressed. It's responding to tenants' needs.
Mm-hmm. Yeah, so you got scale for one, right?
But how does that scale? How do you scale plumbers? How do you scale
in a market?
Yeah.
That's how you do it. So once you
do
get
it?
scale in a market, right, and then you can start to share resources between properties. Obviously, data becomes very important. Learning management systems become very important. And so these are the kind of things that set us apart, basically, right? We have this thoughtful approach where we're looking at how we're actually going to translate our individuals on the ground into improving better. So we track peak performances. We have a bunch of KPIs and these kinds of
So maybe you'd have like a service provider on retainer, for example, that would handle X number of properties for you, which would be cheaper than somebody one-off calling a plumber to fix something.
Oh, we have staff too, right? So we have our own facilities, staff that can handle these kinds of things. Work orders is very
How
important.
much is automated though at this point, like in terms of servicing?
Well, you do have prop tech, right? So prop tech can help you, with an understanding of whether or not there's an issue with certain items in a structure, but it depends on whether or not the structure actually has that yet. And whether or not that's going to be rolled out depends on the investor a lot of times. So
Oh, because of the cost or what?
Yeah, that's right. Yeah, part of the cost. It's going to affect their returns, right?
Interesting. Okay. So the rate environment, how is that impacting? What can you tell us from your vantage point in terms of servicing properties, which is, as you said, and reminded us, the bulk of your business? How is the economic and the rate environment impacting that?
Yeah, so obviously these rate hikes that we've had over the last several years have been critical on the cost of debt, right? So many people who are underwriting properties that they purchased back in, say, 2021, they're now paying a lot more in debt expense than they thought they were going to, and they're not hitting the rents they thought they were going to. There's also more supply than they expected. Now, this is an interesting nuance.
Seriously?
Yeah, so if you look at rent growth at some of these major markets in the Sun Belt, it's down.
Is that because there has been so much development? Because I live in an area just outside of New York City, and rents are pretty high.
Yeah.
And I think some of that has to do, although there's been a fair amount of development. But
I've heard that the rent is too damn high. I've heard that before. Yeah.
In this area?
Yeah,
Whoa!
in this area. Yeah, I've
Stop
heard
the
that.
presses. But are they just done so much building? Like, I know some of these markets, like, remind everybody, we're talking about Charleston, we're talking about Austin, Dallas, Houston, Phoenix, Raleigh, Durham, Jacksonville, Tampa. These are the markets that you guys play in.
That's right, yeah. And so these are also markets, they've been hit by two things really, right? One was the eviction moratoria. This was national and related practices, okay? So that created a tighter occupancy environment than we otherwise would have had. That took rents higher than they otherwise would have been. In the context of zero interest rates, remember back then?
Yeah.
That's a lot of supply. That's all coming to market now. So over the last couple of years, we've seen this slowing rent growth environment that's now gone negative across huge swaths of the Sun Belt. Austin down.
Which is, it's interesting because it's in contrast to what we hear certainly from the Fed and J. Powell, right, about the pressures because of the rental costs.
Exactly. And you're not the only one to notice that. The Cleveland Fed put out a paper to this effect too, talking about how we kind of need to be looking at new lease rent growth in some of these metrics when we think about the kind of data that's feeding into the inflation calculation. Because if you're telling me that shelter inflation is still strong at over 5%, and then granted, I'm only talking about conventional multifamily, that simply doesn't jive with rents being down 8% year over year in Austin, down 4% year over year in Atlanta, down 4% year over year in Orlando, and so on.
Let's not look at it year over year. Let's look at it pre-pandemic. Because some of the places that you mentioned had incredible growth during the pandemic. And we, especially with the rise of remote work, are we seeing a normalization back to rates of 2020? Are we still higher, or 2019?
Oh, we're certainly still higher. Yes,
so,
no question.
so that's what I mean. So if you sort of normalize this, is it as bad as you say?
I think it's bad in the sense that if we're looking at inflation as measured in the CPI, it simply doesn't jive with what we're seeing on the ground. It doesn't jive with what we're seeing in the private sector data sources.
We talked about this with one of our colleagues here, who I think it was Matt Bosler, who wrote that story about how we're looking at this on a national level, but it's a regional story because in some areas that shelter component is
not
exactly.
It is really fascinating to see that. So so what does it mean? All right, so then when you put that into account against the national statistics, I mean, how do you describe the housing market?
Well, so now you want to get into own housing too. It's a little bit of a different dynamic. I think the Case-Shiller data came out. Obviously, the 2020 city index is at a new high. We've got very little volume there, right? NAR shows us there's not a lot of existing, home sales. Even the data for the Case-Shiller, the sales pair, is very low by the standards of the last 15 years. So it's sort of moving up on little volume. We're seeing that channeled to the home builders, right? Pulte Group, D.R. Horton, some of these groups coming out with some good earnings, increasing guidance as well. So I think new housing is certainly benefiting right now in single family.
All you do, Brad, is rental?
We only do rental, yes.
Yeah, okay, so that's interesting. Because part of the other story was that people couldn't afford to buy homes because either, first of all, there weren't supplies or the prices were too high, and that was pushing them into rental. Mm-hmm. Is that a trend that you guys continue to see in the markets you play?
I think we're seeing that now because you've got these high mortgage rates, right? There's just no liquidity, really. I mean, I guess there is liquidity. There's just not a lot of overlap. There's not a lot of volume going on, in the single-family market today or in the owned housing market today. So, yeah, I think what we are going to see here is a continue until long-term rates come down, continued constriction in existing home sales activity, and then that channeling back towards rentals, which in any case are getting much more affordable, at least if you look at these Sun Belt markets.
Big part of the story over the last few years, actually post-financial crisis, has really been there just aren't enough homes for Americans out there right now. New household formations, we're not seeing it. When does that story end? When does that story change, in your opinion?
So in my projection, I think that's going to inflect here in the next couple of years. We'll enter systemic oversupply for the first time since 2001. Now, wow. I'm kind of alone in that outlook. Okay. My gauge, which I use, is using the population 16 and over that's non-institutionalized. A lot of other commentators out there talk about households, which is in part weighted by the household stock itself, the housing stock itself, right? So it's a little bit of a circular reference. It's got very different figures saying, we're underbuilt by 5 million units, and so that's 10 million people you need to house. And yes, we've had immigration of a large scale, but we've also been completing a lot of housing. Those numbers just don't work out for me. I get to a figure that we're underbuilt 500,000 units total, but a lot of that is on the single family side because of the distortions we had in the market over the last decade. Our underbuilding over the last decade has been in single family, no question.
It's just fascinating. Like I said to you, we had too many homes during the GFC, the great financial crisis. People were talking about blowing up homes, just get rid of some of the supply, and here we are, once again. I mean, things are, cyclical, right? Or I don't know. There's a cycle in terms of the build and then the underbuild. So it's kind of fascinating to see. Got to run. Thanks for coming in.
You bet.
Brad Dillman, he's chief economist at RPM Living, joining us here in studio.
You're listening to the Bloomberg Businessweek podcast. Listen live each weekday starting at 2 p.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Well, we don't get retail sales data for the month of April until about 2 weeks from now, but worth checking in with an apparel retailer who deals with a host of challenges each day just to check in on how things are going. We have with us Chris Riccobono, the founder of Untuckit. It's the men's apparel company that designs and sells shirts meant to be worn untucked. In addition to selling online, the company also has 73 stores in the U.S. and Canada, and at a time when many retailers are closing stores, Untuckit is opening them with 14 new stores set to open by the end of the year. Chris, good to have you with us. How you doing? How's business?
Great. Thanks for having me. It's good. It's been a roller coaster of a ride, starting with in 2019, we had opened up 90 stores, expanded into England, Canada. Things were going great. Then obviously COVID hits. Everyone starts buying athleisure, not wearing their shirts out like they do for ours or on vacation or dinner. So it was tough to get through. We managed to get through, and then there were a few more bumps in the road, obviously, with inflation and interest rates. But
how big of a bump in the road was COVID?
It was a big bump.
Because were you guys almost, this is it?
Yeah. We went from selling, from 15 letter of intents coming in for a lot of money to almost going bankrupt in April of 2000. 3 months later, it was a 3 months difference. And it wasn't just because of store closures. It was the trend of moving into athleisure. So we hung on. Everyone stuck with us. They knew we were going to be a great post-pandemic brand with the casual shirt. And they stuck with us, and we made it through. So we took on some debt deals that, are still impacting us in some way today. And then obviously you have the interest rates and inflation. But we're still doing very well today. We had our best year ever in 2022. People wear our shirts everywhere, so it's something they need. So even in a recession or something close to a recession, they need the shirts. They wear them to work. They wear them out to dinner. They wear them on vacation. But it's definitely been a wild ride, much more difficult than it was.
How expensive was that debt to get you through?
It was expensive. It's just gone up and up and up and up. That's the problem.
Were you able to, at any point though, because especially when we moved down to zero and rates, were you able to access or refinance at any kind of lower rates or no?
We didn't refinance. No, it did not happen for a variety of reasons. Obviously, the cap structure's pretty complex, but it's definitely been a challenge. Luckily, we became profitable in 2022. We cut our marketing significantly. A lot of brands, D2C brands, when they cut their marketing, they drastically drop because they realized they weren't really a strong brand to begin with.
Yeah.
We cut our marketing by 15 million, if not north of that, and we grew and as positive EBITDA. Once again, in 2023, our EBITDA also went up and we grew. So, but it's a everyday challenge. As you guys probably hear, people are searching sales more than they ever have.
Yeah.
It's a dramatic difference when you look at the stats of those people going to final sale. It cost me $10.50 to get a Starbucks coffee the other day at the airport. So if you're spending $10.50 for a grande latte, you understand why people need relief, for sure.
So what do you do then? Talk to us a little bit about pricing and how you think about that, so that you are not ruled out by your consumer. And, as you know, coming in here, our producer, other people in the newsroom love your product and wear your product. So how do you think about pricing and also maintain some margins so that you can keep up that profitability?
It's challenging because during COVID, the consumer kind of controlled all the brands. You had that. Think about COVID. Remember, every day it was a wild sale going on. So the customer almost got used to that. We are trying to pull them back to more normalcy, but during a very tough time while all brands are on sale around the clock. We're doing a pretty good job with that. Like I said, we have what I think is a great product that people want, they need, they use in all areas of their life. So they still are willing to spend, a good amount of money on our product. We just know that we have to have product available on sale, but we still, a lot of people buy product at full price, keeps our margins strong. I'm coming across in a way how challenging the environment is, but we are doing well. We're opening 20 stores. We hope to have another 80 in the next 3 years. Not a lot of brands are doing that.
That's amazing in an environment, right, Tim, where everybody's like, just go direct to consumer. Why do you need the expense of stores?
I think we just do it incredibly efficiently. In 2015, everyone said retail was dead. Our buyers said, if you don't open a store, we're not buying from you. We need to touch and feel the product. Even during COVID, people asked me, are you mad that you have 90 stores? I said, it's the best thing we ever did. Your LTV, long-term value, goes up when people come into your store. It's more efficient. Your UPTs go up. People get more attached to the brand. It's how many items you buy.
Okay, got it.
People get attached to the brand. We serve scotch. We have scotch there. There's couches. People compare their fits. They try on the shirts.
Experience.
You leave and you want to come back. So we love it. It's also a billboard in a way, right? You're acquiring. It's very. I'm not sure if you've had anyone who's talked about how hard it is to acquire customers online these days. The cost has gone up dramatically. So we see it as an advantage. While these other brands, these small brands that are eating at you online, they can't open up another 80 stores. So it kind of separates us out.
So on the stores, as I was preparing for this, I saw in a story recently, a Wall Street Journal story, you were mentioned in the context of how you choose locations for new stores using essentially phone numbers and location data from cell phones. Talk a little bit about how you do that and how that determines where you open your next store.
Yeah, it's called Placer AI. It's pretty amazing. So basically, I'll give you an example. We just opened up at Walt Whitman Mall in Long Island, and it was fairly close to some other malls we were in. So we weren't sure, is it going to be the same demo? Are they going to have the same habits? Are they going to pull from the malls that we're already in? And just showed that it was different people who had the same demographic, did the same things. What time they went home, where they went. Did they go to Lululemon before they came in us? Did they go to Starbucks? The people at this mall do the same things that the people at this mall, but they're not currently buying from you. Incredibly detailed information that just confirmed with what the mall was telling us. So it's like another level, and it seems to be working. We were able to identify, 75 more stores down the road that we can open up and not eat into our current customer base and have the same type of customer behavior.
First of all, I'm terrified.
Yeah,
I was going to say, you're being watched.
But I'm not surprised, and I assume that all of that
incredible.
information is just getting so specific. We talk about dossiers that are on all of us, but it's really down to incredible detail. But it does help you make smart decisions in terms of opening up stores. I mean, how quickly does a store become profitable for you guys? Are they profitable?
They are profitable. So about 92% of our stores are profitable. The ones that are not profitable are in cities that have just, the landscape has totally changed post-pandemic.
Like?
Whether it's crime, homelessness, San Francisco.
But that's shifting in San Francisco.
Boston, Chicago. It just depends. Walnut Street in in Philly.
Okay.
Yeah.
It's shifting, but it'll never be what it was where we are.
Right.
Everyone's in a different location.
But you won't shut them down.
Even New York, if you look at certain areas in there's less traffic, right, than there used to be. We will shut them down in the next 2 to 3 years, and we'll funnel them out into the malls that work so good for us.
What's the exit plan here? You started by talking about you had an exit plan right before COVID, then COVID happened. What's the exit plan?
The exit plan is to continue to grow, focus on stores, wholesale. We have no wholesale. There are no brands our size that have no wholesale. We decided to go about it opening stores and spending money to bring in people online. Most brands that start go wholesale. So we have a massive wholesale opportunity ahead of us. We just did a partnership with DXL, big and tall. They had incredible sell-throughs on the small tests we did. International expansion, we'll be announcing some different countries that we'll be going into. Licensing deals come at us all the time. All of these things, we had had it on pause. We wanted to get through COVID. We wanted to make sure everything was okay with our cap table and now focus. So we're not going anywhere for a while. My partner and I love doing this. There's tons of growth ahead. My belief is that a lot of these brands in the $20 to $30, $40 million range, when they have to become profitable, pull back marketing, they're going to run out of money and not be there.
Yeah.
And we're going to kind of be left with some of these other great brands that exist.
But you want to remain private?
Well, we'll see what the exit is. It'd either be a sale or going public. It's whatever kind of presents at the time. We got to get the environment better first. It's just not it's not a great environment for any business if you have high interest rates, you can't recapitalize. You can't.
Yeah.
It's hard to raise money. It's hard to, increase margins, all these different things that we know will kind of turn soon and hopefully. And we're kind of just keep doing the things we're doing in the meantime because it's working.
10 or 15 seconds. I know you're all about the dudes. Anything for women? Or does it make
we
sense?
actually have a women's line, which I have
say?
friends who don't know that because we don't market it. And that's in the works. And our women's line is significant. It's, I don't want to share the percentage of the business, but it does very well. Repeats are there. And one of our plans in the future is to market these other products outside of shirts.
Interesting. Well, Chris, just FYI, we women, we shop. We know how to shop. I understand that percentage.
All right, Chris, thank you so much for joining us. Chris Riccobono, founder of Untuckit, here in our Bloomberg Interactive Brokers studio.
This is the Bloomberg Businessweek podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live weekday afternoons from 2 to 5 p.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.